Most people think estate planning is something that you do at the very end. Like, I'll get around to it when I'm older, set up a will, name some beneficiaries, call it done. But if you spend decades building real wealth, a business, a real estate portfolio, significant investments, waiting till the end might be the most expensive mistake you never knew you made. And the frustrating part is this: the IRS can tax your estate on assets you no longer needed at a rate you could have dramatically reduced using tools that were available to you the entire time. If that sentence made you stop and think, good, because this is one of those quiet issues that tends to show up right when it's too late to do much about it. My name is Justin Kuntz. I'm a certified financial planner and managing director at Pacific Wealth Management. In this video, I'm going to walk you through what family limited partnerships and family LLCs actually are, how they work, and why high net worth families use them, because once you understand the mechanics, you can spot the opportunity before the window closes. And we'll do it by following a situation that's more common than most people even realize. So hypothetically, let's meet Robert and Diane. They're both 67. They built a commercial real estate portfolio over 35 years. They have a brokerage account, a vacation property, and business interest that still generates income. They're not reckless with money. They actually are pretty careful. They've worked with a CPA for decades. They've got wills, and they feel reasonably organized. But when their estate attorney pulls up the numbers, something shifts. Between the real estate, the investments, and the business, their combined estate is well above $30 million. And in 2026, the federal estate tax exemption is $15 million per person, $30 million for a married couple. Anything above that gets hit with a 40% federal estate tax at death. Robert looks at the number and says, so we spent 35 years building this and the government takes 40 cents on every dollar above the threshold? That's the conversation nobody enjoys having. But it's the one that leads to real solutions. So here's what we're going to cover, because this is where almost everyone has that actual gap. First, the core question: what are family limited partnerships and family LLCs, and how are they different from just giving money to your kids? Second, the valuation discount, the often overlooked mechanism that makes these structures genuinely powerful, and how it lets you transfer more wealth while reporting less of it to the IRS. And third, the control question, because the number one fear families have is, if I transfer assets, do I lose the ability to actually manage them? And finally, the execution risk, because these tools are real, but they're also easy to get wrong. And knowing where the traps are is just as important as knowing the benefits. Let's start with the core idea. The family limited partnership, or FLP, and a family LLC, or FLLC, are both legal structures that let you transfer ownership of assets to family members during your lifetime, while keeping control within your hands along the way. Think of it this way. Right now, Robert and Diane own their real estate portfolio directly. That means that when they pass, the full market value of those properties gets counted within their estate and taxed accordingly. But if they transfer those properties into a family LP or LLC, they can start gifting ownership interest in the entity to their children and grandchildren over time. And here's where it gets really interesting. Those gifted interests aren't valued the same way as the underlying assets. That's the first mental shift. When you give an asset directly, cash, stock, property, the IRS values it at full market value. But when you give a minority interest in a family LP or LLC, the IRS applies what are called valuation discounts. So why? Because a minority stake in a family entity is worth less than the underlying assets it represents. A limited partner or minority LLC member can't force a sale. They can't make management decisions. They can't put or pull all their money out whenever they want. And because of those restrictions, the IRS allows the gift to be reported at a discounted value, typically somewhere between 20% and 40% below the asset's actual worth. So if Robert and Diane gift an interest representing $100,000 in actual real estate, they might only be required to report $60,000 or $70,000 on their gift tax return. That's not a loophole. It's a feature of how these structures are legally recognized. And it's been tested and upheld in the tax code for decades. Now, why does that matter so much? Because the annual gift tax exclusion has limits. In 2026, you can give up to a certain amount per recipient per year without tapping into your lifetime exemption. When you apply a 30% discount to each gift, you're effectively moving more wealth out of your estate per year than you could any other way. Over a decade of strategic gifting, the difference in what remains taxable at death can be pretty enormous. Now let's talk about who these structures work for, because they're not necessarily for everyone. The use case has 3 conditions, and Robert and Diane hit all 3. The first, you want to transfer ownership of your assets to your heirs during your lifetime. Not because you're required to, not because you're sick, but because you're doing it now while you're here to structure it properly. And that is dramatically more effective than leaving it to your estate. Condition 2, your estate has or is likely to exceed the exemption threshold. In 2026, that's $15 million per person or $30 million for a married couple. If your estate is well below that number, these tools are probably more complex than they're worth. But if your estate is above or growing towards that level, then you're looking at a potential 40% tax on everything above the line. And that's when the economics of planning start to make serious sense. The third condition, you want to maintain control. And this is where most families hesitate. If I put my real estate into a family LP, can my kids force me to sell? Can they make management decisions? Do I lose the ability to run things the way I want to? The answer, when structured properly, is no. And this is one of the most misunderstood aspects of these tools. An FLP designates what's called a general partner, and the general partner has executive control over investment decisions, distributions, and management of the assets. Robert and Diane can be the general partners in this case. Their children can receive a limited partnership interest, meaning they have economic participation in the entity, but no management authority. And the same principle applies to family LLCs. The operating agreement designates a manager who controls decision-making. Robert and Diane can basically be the managers indefinitely. So they can give away 40, 50, 60% of the economic value of the entity over time while retaining 100% of the operational control. That's a meaningful distinction, especially for families who built their wealth by being hands-on and aren't ready to necessarily hand over the keys. Now let's talk about the income tax side, because this part often surprises people. When Robert and Diane own everything directly, all the income those assets generate, rental income, dividends, capital gains, flows through them personally. And at their income level, they're likely paying the highest marginal rates. But as they gift ownership interest of the entity to their children, the income that flows to those interests becomes taxable to the recipients, not to Robert and Diane. If their adult children are in a lower income tax bracket, the family as a whole may pay less in tax on the same income stream. Not because anything is hidden, but because it's now distributed across more people at different tax rates. This doesn't make the FLP or LLC a silver bullet on income taxes, because it's not. But it is a meaningful secondary benefit that compounds over time, especially in income-producing real estate. Now let's talk about the part that tends to make people a little more nervous. These structures are powerful, but they come with real execution risk, and this is where the conversation changes, because it's not just about whether an FLP or FLLC is right for you, it's about whether it's implemented correctly. So here's where it can go wrong. Risk number 1, an improperly drafted operating agreement. The operating agreement is the document that defines the rules for the entity itself, who controls it, how distributions are made, what limitations apply to minority interests. And if that document isn't drafted carefully, the IRS can challenge the valuation discounts under an audit. And if they succeed, the tax savings you expected to evaporate, possibly along with penalties and interest on top of that. This is why generic templates and one-size-fits-all documents are so dangerous in this space, because the discounts have to be defensible. The structure has to reflect the economic reality. Risk number 2, the limited partner who acts like a general partner. So this sounds technical, but it matters in a practical way. In an FLP, if the limited partners have limited liability, meaning they're not personally responsible for the entity's debts, but that protection depends on them actually behaving like limited partners. So if a limited partner, say one of Robert and Diane's children that's an adult, starts making day-to-day investment or management decisions, signing contracts, acting like they're running the show, a court can reclassify them as the general partner. And general partners in an FLP have unlimited personal liability. If Robert and Diane put those assets into an FLP, continue to treat those assets as personal property, pay personal bills from the entity, or ignore the formalities of proper business structure, The IRS can argue that the entity should be disregarded entirely. The discounts go away. The planning goes with them. This is why these structures require ongoing attention, not just a one-time set and forget it type of thing. So here's the real takeaway. Robert and Diane didn't do anything wrong by building wealth. They saved, they invested, they built things, and now they're facing the natural consequence of success in a system that taxes large estates heavily. The frustrating part isn't that estate taxes exist, it's that the tools to legally reduce them have been available the whole time, and most families never learn about them until it's too late to use them or take advantage of them. Family LPs and LLCs aren't exotic or aggressive, they're well-established planning vehicles used by families with significant estates every single day. But they require the right timing, the right structure, and the right team. So if you're looking at your estate and thinking, there has to be a smarter way to do this, the next step isn't just guessing. The next step is getting clarity on three things: whether your estate is large enough to make these structures economically meaningful, what assets make the most sense to contribute, and whether the execution risk is manageable given your family's specific situation. If you want help reviewing your estate plan for tools like family LPs and LLCs, click the link in the description to book a free call with us. Because in estate planning, the most expensive decision isn't the one you make poorly, it's the one you put off until it no longer matters. Thanks for watching.